The Oracle of Omaha, Warren Buffett, has lived and invested successfully in various bear markets. Now, when we look at it chronologically, Buffett has lived through 13 of the nastiest bear markets. In those bear markets, Buffett watched the market plunge way below 20% or even greater than 35% in some instances. And these situations wiped out billions in wealth for many stock market investors. But what if we tell you that bear markets are not something you need to be afraid of and you can use it to your advantage? Buffett has managed to make billions of dollars along with the shareholders of his company, Berkshire Hathaway. If any investor is qualified enough to share his wisdom on investing in bear markets, then it's Mr. Buffett. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. To put things straight, bear markets are defined as market periods when the stock prices go plunging below a 20% decline rate. And truth be told, it's chaos out there for many investors who want to get rid of their stocks as soon as possible. Whether it is the dot-com crash from 2000 to 2002, where the decline ranged above a devastating 36%, the COVID bubble, or the recession from 2007 to 2009, which is also known as the second worst bear market, investors have always found it difficult in these conditions. In June 2022, the S&P 500 index entered a bear market for the first time since March 2020. And there is no better way to get our investing strategies straight than investing the Warren Buffett way. In this video, we're going to break down Buffett's investing strategy during bear markets and how he manages to get all of his angles covered, whereas the other part of the investing world suffers a significant blow. Interestingly, Buffett cites that the growth rate of the S&P 500 between 1942 and 2019 averaged around 11.8% annually. He describes that if he had invested his savings of $114.75 in a no-fee S&P 500 fund in 1942, it would have been worth more than $606,811 by 2019. Now, for those of you struggling with the math, it's more than 5,288 times the original. For those of you wondering, this growth happened despite several devastating dramatic bear markets and recessions within the same time frame. According to Warren Buffett, the long-term growth potential of the US stock market is an indicator as well as a justification for the buy and hold strategy, instead of selling stocks when the market rate declines more than 20%. Now, buying and holding stocks over the long term involves purchasing stocks of well-run companies. Buying and holding stocks involves companies with proven track records. You then keep those stocks as long as there is no fundamental negative change to the company's business model. Buy and hold investors accept cyclical volatility and bear markets. They hold on to their stocks during tough times because they know that a good period of stable growth will follow. According to Buffett, value investors should take the bear markets and recessions as opportunities to find undervalued stocks, so that when the recession passes, the stock of their choice grows over time. For example, let us just say that Walmart is a stock that was performing very well before the recession took place. But once the recession takes place, its share price goes from $220 to $120 in a quick period. You notice that there's chaos unfolding in the market and people are just getting rid of this stock. Its share price falls close to $100 and then you decide to invest the Warren Buffett way. You remembered one of Warren Buffett's seminars and you decided to buy low. You noticed that the business model was still working great and the balance sheet was still performing well. Everything was normal, and once the bear passed, you made some serious gains over the long term. You made 10 times your money. According to Warren Buffett, value investors need to hold on to their stocks during these tough times because a growth period is certain to follow. Also, that the growth will be significant and it will produce significant annual returns for you, which will allow your stocks to outperform other asset classes like currency or gold. We've classified Buffett's investing strategy as an easy framework for you guys so that everyone can implement Warren Buffett's wisdom in their stock market journey. The first step should be to look for well-established companies within your circle of competence. Remember that a circle of competence is an area or a niche that you understand better than other fields or areas. These companies should have a good historical performance pattern against the bear markets. They should have manageable debt, reliable cash flow, and disciplined leadership. Now, if you are finding it hard to get your head around some stocks, then the ideal approach can be the S&P 500 Index Fund, which will get you into the largest 500 publicly traded companies in the US. Once you invest in some of these stocks, then Buffett wants you to hold on to these stocks until you have a good reason not to. Now, a market-wide decline in stock prices is not a good reason to dump a stock. That's a temporary cycle or a situation that will resolve itself sooner or later. A good reason to dump a stock would be a change in the company's business model that affects the company's long-term prospects. Note that you wouldn't have to go through this tough decision-making process if you're investing in the S&P 500 fund, because if a company gets dropped from the index, the fund will drop it too. Next up, you need to wait for the long-term gains to materialize. This means that you need to let your equities grow for long periods. Let them grow for decades and through bear markets. If you are investing in stocks that provide stable dividends, reinvest them and use the compound interest to your advantage. Remember that compound interest works best over long periods. The longer the snowball rolls down the hill, the bigger it will be the time it reaches the cliff. Buffett buys quality merchandise on sale. That also means that value investors should invest in high-quality businesses, companies with proven quality and the ability to create shareholder value through all economic climates. For example, earlier this year, Buffett responded to the tech stock sell-off by buying even more of his favorite technology company, Apple. Although 40% of Berkshire's portfolio already consists of Apple, this move comprised another 3.78 million shares of Apple. Similarly, other value investors can also follow his strategy by buying more of their favorite stock with a great business model. When a bear market steps in, you'll mostly see Buffett buying or holding. If you're wondering whether those moves are the best moves for your portfolio, then you should remember that Buffett is worth more than $95 billion, and he has seen and invested in more bear markets than most of those financial advisors on the internet or television. His tactics can help you emerge stronger from this bear market, and you can be wealthier than ever. When asked about what advice he will give to value investors during tough times, he said, "I would tell them, don't watch the market too closely. Sometimes it is okay to keep some distance from the market headlines. Consider it a survival strategy that helps you survive and stick to your investing strategy during tough times. Let us say you're confident that your hold forever stocks can withstand a temporary bear market, and for that reason, you're not going to react to falling share prices. In that scenario, what's the benefit of tracking every move the market makes? There isn't one. But one thing is for sure, your success in the stock depends on how well you can analyze stocks. It's very important to understand all of these stock categories out there so that you already have your moves calculated. This is the reason we've provided you guys with a free ebook in the comments section below, which will explain the 6 stock categories in detail. Check this video we picked for you, and we'll see you in the next one.